The rise of invisible middlemen. They rarely appear in headlines, yet they stand between almost every major financial transaction. They don't lend their own money, and they don't always take visible risk. Instead, they connect, route, price, and structure the flow of capital, quietly shaping outcomes without ever becoming the story. To understand why these invisible middlemen matter today, we need to look at how modern finance learned to separate ownership from control. As markets grew faster and more complex, direct relationships became inefficient. Banks no longer held loans they originated. Investors no longer knew borrowers personally. Into that gap stepped intermediaries whose role was not to create value directly, but to organize it. These actors multiplied as efficiency became the system's priority. Brokers matched buyers and sellers at scale. Clearinghouses stood between counterparties to reduce visible risk. Payment processors moved money instantly across borders. Asset managers structure exposure for clients who never touched the underlying assets. Each layer made the system smoother, faster, and more scalable. At first, the benefits were undeniable. Costs fell, liquidity improved, access expanded, markets became easier to enter and harder to understand. Responsibility dispersed across chains of contracts rather than resting with a single institution. When something worked, no one questioned who truly carried the risk. But this separation changed incentives. Middlemen earned fees regardless of long-term outcomes. Volume mattered more than durability. Complexity became an asset, not a flaw, because it justified intermediation. Risk did not vanish. It moved downstream, upstream, and sideways, often settling with participants least equipped to manage it. As reliance grew, so did opacity. Transactions passed through multiple hands before completion. Pricing reflected models rather than relationships. Failures became harder to trace because accountability was shared or unclear. The system became efficient at processing activity, but inefficient at revealing vulnerability. For regulators, visibility narrowed. Oversight followed institutions, while influence followed networks. A disruption in one intermediary could ripple through markets without triggering traditional alarms. The system appeared diversified, yet depended heavily on entities few outside the industry fully understood. For the public, the middlemen remained unseen. Services felt seamless. Costs seemed low. Stability appeared intact. Few questioned who controlled the flow beneath the interface, or what would happen if those silent connectors failed. These early conditions set the stage for a system where power did not reside solely with those who owned capital, but with those who moved it. And when intermediaries become indispensable, their invisibility becomes the greatest risk of all. As invisible middlemen embedded themselves deeper into the system, their influence grew in ways that were easy to overlook. What began as support functions evolved into critical infrastructure. Entire markets depended on their ability to route trades, manage settlements, assess risk, and maintain continuous flow. Their reliability was assumed, not questioned. Intermediaries thrived on scale. The more transactions they processed, the more indispensable they became. Networks consolidated. A handful of platforms came to dominate clearing, custody, and payment flows. Redundancy declined as efficiency improved. When everything worked, concentration felt logical. When something failed, the consequences became systemic. Their business models reinforced this trajectory. Fees were tied to volume, speed, and complexity. Innovation focused on expanding reach rather than strengthening resilience. New products increased dependence on intermediaries rather than reducing it. Each improvement made markets smoother, but also more tightly coupled to a small number of unseen actors. Risk quietly accumulated within these nodes. Clearinghouses absorbed counterparty exposure. Custodians concentrated asset control. Payment networks managed vast sums in real time. Yet because these entities did not always take directional risk, they were often viewed as neutral, plumbing rather than pillars. Oversight reflected this assumption, treating them as service providers rather than potential points of failure. Inside institutions, reliance became routine. Firms optimized operations around intermediary capabilities, shedding internal functions to reduce cost. Contingency planning assumed uninterrupted access. The idea that a central connector could fail felt remote, almost theoretical. Trust in the system became trust in its infrastructure. Markets rewarded this structure. Faster execution, reduced friction. Lower costs increased participation. Liquidity improved. Each benefit reinforced dependence. The system grew more efficient and more fragile at the same time. When disruptions did occur, they were often minor and quickly resolved. A delayed settlement, a brief outage, a pricing error corrected within hours. These incidents served as reassurance rather than warning. Proof that the system could recover. Proof that safeguards existed. The deeper implications went unnoticed. For regulators, the challenge was classification. Intermediaries did not fit neatly into traditional risk categories. They did not lend like banks or invest like funds. Their influence came from connection rather than exposure. Monitoring them required a shift in perspective, from balance sheets to networks. This was a quiet buildup. A system increasingly dependent on invisible middlemen, whose failure would not look like a bank run or a market crash, but could trigger both. And the more seamless the system became, the harder it was to imagine life without them. Because when intermediaries become infrastructure, their silence is mistaken for strength. The conflict emerges when an invisible middleman falters, not dramatically, but briefly. A delay ripples through settlement. A system outage pauses transactions. A clearing requirement tightens unexpectedly. Each disruption is small, yet its impact spreads far beyond the point of failure. What was once background noise becomes a signal that the system depends more heavily on these connectors than anyone admitted. Because intermediaries sit at the center of networks, stress concentrates quickly. When one node slows, others compensate. Liquidity is rerouted. Collateral demands rise. Counterparties grow cautious. Actions taken for protection amplify pressure elsewhere. The system reacts not to loss, but to uncertainty about flow. Institutions accustomed to seamless execution struggle to adapt. Trades cannot settle on time. Margin calls arrive earlier than expected. Contingency plans assume problems will be isolated, not simultaneous. When multiple intermediaries face strain at once, the assumptions underlying daily operations begin to unravel. Markets respond with sensitivity. Prices move not on fundamentals, but on confidence in infrastructure. A rumor about system reliability can trigger rapid repositioning. Assets tied to delayed settlement lose appeal. Liquidity fragments as participants retreat to channels they trust. The system becomes uneven, efficient in some areas and frozen in others. Regulators confront a familiar dilemma. The intermediaries at the center of disruption are essential, yet lightly understood. Their failure would not resemble a traditional collapse, but their interruption could halt activity across markets. Intervention risks moral hazard. Inaction risks paralysis. The tools designed for institutions struggle to address network failures. Public awareness lags behind impact. Transactions slow. Payments are delayed. Services feel less reliable. The cause remains obscure. Trust erodes without a clear target, making response more difficult. When infrastructure fails quietly, accountability becomes diffuse. The conflict deepens as reliance turns into exposure. What once looked like efficiency now appears as concentration. Redundancy, once seen as wasteful, becomes valuable. The cost savings achieved through centralization are weighed against the risk of systemic interruption. The lesson sharpens under pressure. Invisible middlemen do not merely support the system. They shape its resilience. Their strength determines how stress moves, how quickly confidence recovers, and whether disruption remains contained or spreads. The system reaches its most fragile point when it realizes that failure does not need to be catastrophic, to be dangerous. Sometimes, all it takes is a pause in the connections everyone assumed would never break. The reckoning arrives when the system finally acknowledges what had long been ignored. Invisible middlemen are not neutral pipes. They are pillars. Their reliability determines whether markets breathe freely or seize without warning. And once that truth becomes clear, the idea that they can remain unseen is no longer acceptable. Intervention follows, not with dramatic rescues, but with structural change. Regulators widen their lens from institutions to infrastructure. Stress testing expands beyond balance sheets to include settlement delays, payment interruptions, and network failures. Redundancy, once dismissed as inefficiency, is reintroduced as protection. The goal shifts from speed alone to continuity under pressure. Intermediaries adapt in response. Safeguards are strengthened. Capital and collateral requirements are reassessed. Systems are hardened against failure, not just optimized for performance. Transparency increases, not because it is convenient, but because invisibility is now understood as a source of risk. What moves unseen can fail unseen, and that is no longer tolerable. Institutions adjust their assumptions as well. Dependence is examined. Contingency plans grow more realistic. Relationships diversify, even at higher cost. The system learns that efficiency without resilience is not strength. It is exposure disguised as progress. For the public, the change is subtle but meaningful. Fewer disruptions, faster recoveries, greater confidence that the machinery behind daily transactions can withstand stress. Trust returns not because the system is flawless, but because it is better prepared for imperfection. Looking back, the rise of invisible middlemen reveals a deeper pattern in modern finance. Power does not always sit where risk is taken. Sometimes it sits where connections are made. Those who move capital quietly can shape outcomes as profoundly as those who own it openly. The enduring lesson is clear. What holds a system together deserves as much attention as what drives it forward. Infrastructure is destiny, and when the middle becomes indispensable, it must never remain invisible again. Subscribe to join the journey. The